Can everybody see the screen I'm sharing?
Yes.
All right.
Yep.
So this is for the public. This is David Goldman, the City of Oak Harbor's Finance Director. And we can kind of go around and introduce ourselves. Whoever wants to go ahead and do it.
Dan Evans, City Council.
Brian Stuckey, City Council.
I'm Chaz Webster, staff for City of Oak Harbor.
Tim Schofield, U.S. Bank Commercial Banking.
And Jason, you don't have your sound on.
Yeah, his lips are moving, but.
Still not hearing him. I'll go ahead and introduce myself, Blaine Oborn, Oak Harbor City Administrator.
Yep, and then that's Jason Joyner, committee member. All right, so I put this presentation together to kind of go over where our investments are at and how we've been doing as far as the investments go. And also I provided some economic indicators for the background. So agenda, I guess we got the public comment. Are there any members of the public who want to say anything? Okay, hearing none. Let's go ahead and do the investment report. So we have 23 bonds. This is the first page. The settlement date, you can see the description of the bond in the left column, whether it's a treasury or what federal agency the bond has been issued from. The settlement date, that's the date we purchased the bond, or maybe a day after we purchased it when it actually settled. That's the coupon rate, but that's kind of irrelevant because we pay a discount or a premium. And there you have the yield to maturity rate, which is the true rate of return. This column here, well, this column is the par value. That's the value on the face of the bond, either 2 million or 1 million. And this is the maturity date. This is when we get to roll over the bond to a new investment or get to just keep it in the bank if we need the cash to run operations. And the last column is the days to maturity. That's the number of days out from today to maturity date, or actually from the end of November to maturity date. Here's the next page. You can see the latest bond that we picked up yields almost 5%. And I'll go over some of the yield curves in a few slides. The total weighted average for the treasuries and the agency bonds is about 2.37%, $44 million. The local government investment pool, which is the same as cash equivalent, about 23.7 million in that, and that yields 3.75%. So the weighted average of those two is 2.86. In our investment policy, the investment return benchmark we're trying to match is the 6-month treasury, and that's actually 4.7%. Things are a little bit unusual out there right now, where the shorter terms are yielding more than the longer terms. So I'll get into that in a bit, but that's one of the reasons why it's almost impossible to make the benchmarks nowadays because of that, the yield curve situation. So about 2/3 of our portfolio are in the federal agency bonds and treasuries, and the other 1/3 of our investment portfolio is in the local government investment pool.
Hey, David, can I ask a question?
Yes.
That 4.7%,
Yes.
when it says it's our target, was that a target that was made by the city council at some point? Where did that target number come from?
It's in the investment policy, which was adopted by the city council a few, I forgot exactly when, maybe 2016.
Gotcha. Okay.
Yeah, and normally we would meet that, but because things are a little wacky right now in the market, well, I'll show you in a minute in a few slides.
A little wacky. That's what.
Yeah, you'll see. You'll see. So our total investments, this is including our bank and those investments I talked about, is at $83 million. You'll see back here in 2016, this is when we received the bond proceeds to build the clean water facility. And this is when we were spending it down. And we reached a TRO around here in January 2020, and our balance has been building ever since. This line broken down into its component parts are as follows. Our primary bank account is the blue line. Our orange here, or yellow, are our investments. It started at about 22 million, went down to 0. And then we started following the investment committee's direction. We started reinvesting our funds again. So this is the 44 million. And this is an account we no longer have. And then this gray line is the local government investment pool.
And David, what accounted for that big increase in our investments between May and July of 2022?
Oh, we were following, the last meeting we had was in May, and we were told, hey, go ahead and invest and try to earn interest. And that's what we've been doing with idle cash. So here's the economic indicators. So at the beginning of the year, you can see that, and these are broken up by bond terms. So the blue line is a 1 month bond, then 3 months, then the orange is 6 months, 1 year, 2 year, and so on. And you could see that in a normal environment, as the lengths increase, the yield you get from the investment increases as well. But as time went on this year, things changed a bit. You can see that the 6 month actually yielded higher than the 10 year around mid-July. And then you can see that the 3 month eclipsed the 10 year here in August, and then it was under, and then it surpassed the 10 and 30 year in October. And then the 1 month is actually yielding higher than the 10 and the 30 year earlier around the first week or so of November. So what that looks like on the yield curve continuum would be this. The orange or yellowish orange would be the yield curve from the 1 month all the way to the 30 year. You can see that the yield goes up. This is in June, and then it started to flatten. 3 months later, in August, the yields for the short-term issues were much higher than they were 3 months earlier, and then you can see that it flattened, and it actually is a little bit higher. It was a little bit higher. The 2 and 3 years were a little bit higher than the longer-term issues. And as of December 1st, you can see that the curve is inversed. The 1, 2, 3, 6 months, 1 year yields are higher than the longer-term yields. And what that looks like when you just subtract like the 2 year and the 10 year and the 3 month and the 10 year, you can see that the difference actually goes under 0 in July for the 2 to 10 year. And from the 3 months to the 10 year, it goes under 0 in October. And what that basically says is, what people talk about when that occurs is it's an indicator of an upcoming recession. Because what's really happening is when the Fed has an auction for bonds, investors get to decide, like, what are we going to bid on? And investors who think that the interest rates are going to go down in the next year or so might want to lock in rates before that happens, because that means the bond that they're going to hold in about a year is going to be more valuable than a bond that they can get in a year. So there's more demand at the auctions for these terms than there is for the shorter terms. And when there's more demand at the auction, the yield that has to be offered goes down. So if you think that interest rates, if the Fed's going to start lowering in the next 6 months to a year, that's really going to affect the shorter term areas of the yield curve. And if you're holding a bond that yields slightly less than that, like a 3.5% as opposed to 4, but if in a year the 7 year or 10 year bond's yielding only 2% and you're holding a 3.5 to 4% bond, you actually have a good investment. You can sell that bond and make some money on it. So so this is one of the reasons why you have an inverse yield curve. If people think that these rates are going to end up going down in the next 6 months to a year. This is the consumer price index. You can see that it really ramped up in 2021 and early 2022, and it started to come down in the last 4 months or 5 months. It's starting to kind of level off and come down. This is the producer price index, or like the equivalent of the CPI for producers. It has a similar trajectory. This is the federal funds rate upper limit. Beginning of the year, they did a 1/4 point, then a 1/2 point, then 3/4, 3/4, 3/4, 3/4. I think they'll be meeting again later this month, and we'll see if they do a 1/2 point or if they end up doing something different. There's 18 free open market, federal open market committee members that provide their outlook of where they think the federal fund rate will be in the future. And it looks like, based on the feedback that was provided by this board, by the open market committee, that they think rates are going to be a little bit higher than they are now in 2023 and then come down in 24 and 25. Of course, this is a very dynamic chart. This will probably change when they have a meeting and have another vote. This will change. We're not sure if it's going to go a little bit higher, a little bit lower, or stay the same. As far as CPI goes for Seattle itself, the Seattle metropolitan area, which covers kind of this whole northwestern part of the country, in Washington State, the 12-month trailing CPI to October 2022 was 8.9%. And the main drivers of that were food, eating out or eating at home, housing, and motor fuel. For the last 2 months, it's been 1%. And the major drivers of that 1% were eating out. The food at home actually decreased over the last 2 months. So it was really eating out that increased, motor fuel and recreation. So you can see that, if you go back 12 months, you add up all these numbers, you'll get something near 8.9%. But for the past 4 months, it's been about, what's the average? 0 to 1, about 0.5% for the last 4 months. If that continues to happen for a few more months, you'll start to see the 12 months trailing also go down, depending on what happens with inflation. So this is the LGIP versus the federal funds rate. And as you can see, that the LGIP yields track pretty closely with whatever the federal funds rate happens to be. So the overall investment outlook, based on the bond investments that we have locked in interest earnings for 2023 of almost $800,000 for the city. We'll continue to roll the bonds over on maturity and look to invest available idle cash to continue the interest earnings going forward. For the LGIP, as I mentioned, the LGIP tracks pretty closely to the federal funds target limit. For the month of November, the LGIP earned $73,000. At the beginning of this year, I could tell you it was earning almost nothing. It was earning like $2,000 or $3,000 or $4,000, but now it's earning $73,000 a month. If that was to happen for 12 months, I mean, that's more than this. That's like $880,000. And that all depends on whatever the Federal Reserve governing body does. If they continue to bring it up, we'll earn more money out of the LGIP. But if they start to ramp it down next year, these earnings will go lower, and it may affect whatever the bond market has to offer as well. So for 2023, though, our interest earnings do look pretty healthy, pretty robust. And that's all I have.
So there's no action on our part. This is just informational only.
Yeah, it's just informational only. We're just providing you where we are, and things are going pretty darn good, actually. I mean, it's always good to earn more interest. The only problem is when we go out to bid for projects, we end up getting costs that are higher than we originally anticipated, like with that Harbor Lakes or Harbor Heights Parks a few months ago when we came back and we found out it was more expensive. So that's the downside of it. Costs go up, but the good part is, we do get more interest earnings.
David, thanks for the info. I'm glad that our our strategy seems like it's working out pretty well from what we've been planning over the last few years. A couple of thoughts. One is there was a large dip in the checking account cash.
Yeah.
And do we need to then move some funds or make some more available for investments, or is operational funding still fine?
Oh, we're
And then
fine.
where does that
We wouldn't have
leave?
made those investments. We wouldn't have made those investments if we needed the cash to pay our operating, but we have sufficient money in the,
Okay,
and if we need to, we can always draw some from the LJP because it's the same day or the next day.
okay. And then as far as idle funds, we were on a trend of buying, I think it was 2 million a month for quite a while there.
Yeah.
Do we still have idle to continue that, or are we now on a maturity renewal basis?
We might have some more idle cash. It depends on it just depends on our revenues and expenses. Right now, I wouldn't want to invest any more money until next year, depending on what our outlook looks like. But right now, it would really be more of a maturity basis.
Perfect. No, that sounds great. Thank you.
Sure.
Okay. Would you give that meeting date one more time, the next meeting?
Oh, yeah, it'll be,
Or email it. Maybe email it might be good.
yeah, we're going to email that, set up a meeting and everything. It'll be February 23rd at 1:30.
Okay.
And are we doing that virtual again, or is that one going to be in person?
Well, it's both. I mean, you can come in person if you want, or you can do virtual.
Perfect. Thank you.
Okay, joke.
And David,
Yes.
I know this is more the investment side, but on the selling side, just as an FYI, I think we mentioned it too. I think the council members know, so some of the other people on the investment committee, that we're going to be going out on the sales side for with the approval of the 60%, 62%. We needed 60 for the new fire station.
Mhm.
And so that's kind of separate from this side, but just as an FYI, that's like 9.2 million, I believe, David.
Yeah, $9.2 million bond, which will be funded by the property tax revenues the voters voted for.
And then if we have representatives here on the banking side, certainly they're welcome to participate in or to look at our perspective and to bid on that.
Looking forward to it.
Thank you.
All right. Are there any more questions or comments?
We're good.
All right. Thanks a lot, everybody.
Thank you.
Thank you.
All right, take care.
Thanks, everyone.